It's come to light that all four big Australian banks, being Commonwealth Bank, ANZ, Westpac and National Australia Bank, have been hit by an increase in bad or in doubt loans. These particular loans they're talking about in their statements just recently, the capital that they've actually lent to iron ore producers like Orion, and there's another one, American-based one, that has mines and interests in Australia that produces coal, and we know what's happened to the iron ore and coal prices. Well, some have called the bottom in the resource sector, but I think it's only the beginning. It's a dead cat bounce. This little bounce that just happened recently in an iron ore price and coal as well, but that's not going to last according to my research. And my research is basically just following people in the know. I'm not an expert. My expertise is elsewhere. So another very important part is how can we talk about anything financial in Australia without, and that being banks' financial performance, without talking about property. The mortgage debt is 60% of the big four banks' book. So apparently that's the highest in the developed world, where the 60% of the bank's books are mortgages to housing market. So let me get this right. Think about the investors, mums and dads. I always talk about them. Pensioners. We all have superannuation. It's a saving for the retirement. So most of these are heavily invested in banks. So if banks go down, then our investments, our retirements go down. If the property goes down, and because banks have 60% of their debt on their books in property, then the bank shares go down as well. So most retail investors are invested in banks one way or the other, through their superannuation or through their brokerage accounts, just directly buying bank shares, chasing the yield, because you can get 5-6% fully franked dividends. And then we know that in Australia, everyone, the taxi driver and everyone else, has multiple investment properties. So one will pull the other one down. Doesn't really matter which one starts going down. It's a snowball effect. So we'll all be affected. So you may ask, what do you buy? Is it precious metals? A lot of the gold bugs are saying buy gold, buy silver, physical, buy bullion, buy coins. I'm not too sure about that. I think the next time the global financial crisis hits, everything is going to go down. There'll be a huge deflation, which only leads me to believe that the cash is king, that you got to keep the cash, keep liquid, be ready to pounce at investment opportunities, buy those distressed assets, buy bank shares when they're half in value, buy property probably a few years down the road, because it takes a little while for property to actually turn down and to materialize in lower prices in the market. And yes, buy gold and silver once it's bottomed out. I don't think it's at the bottom. Again, people I follow don't believe that. Harry Dent, maybe. Peter Schiff has a different opinion. Martin Armstrong, look them up and see what they say. But I've followed them for years now, and it just seems that the best place to be is cash, and wait for this debt bubble to unravel. Debt bubble meaning the banks, the property, even precious metals, the stock market.
Commodity crunch is now hitting the bottom line for the big banks. Bank shares slumped as much as 6% today after ANZ surprised the market with a $100 million hit in bad loans. Those loans are mainly to international coal giant Peabody and struggling South Australian steel producer Arium. One of Australia's most experienced fund managers says ANZ Bank may have to cut its dividend as those bad loans increase. Now Westpac has also flagged increasing problems with some loans. Andrew Robertson reports.
Big dividends from the big banks have been a refuge for investors in the post-GFC low interest rate environment. Now it seems the party could be over.
I think there's a good chance that ANZ might cut its dividend.
The shock announcement from ANZ was that it's increasing its provision for bad debts by at least $100 million thanks to its exposure to companies in the resources sector. Just a few weeks ago, ANZ had claimed a total provision of $800 million was adequate.
If you want to announce an impairment charge and you're a public company, you'd better get it right and not have to make another announcement a month later. That shows that you don't, or that you may not be on top of your provisioning.
Which is why investors are now nervously wondering what lies ahead from ANZ in particular and the other banks in general.
The market does hate surprises, does hate shocks, especially coming only a couple of weeks after the last update with the $800 million figure.
At the heart of today's announcement from ANZ is understood to be its exposure to two companies struggling to stay afloat, iron ore and steel producer Arium and the world's largest coal miner Peabody. Peabody has been crippled by the plunge in coal prices which followed its now ill-fated $5.5 billion takeover of MacArthur Coal. Just 2 years ago, if you could believe its then CEO, coal was a no-brainer.
Right now, we've got 3.5 billion people globally that don't have access to electricity. We got half the children in the developing world that go to school with zero electricity.
ANZ has the highest exposure to the coal industry of the big four banks, and what surprised the market is the speed with which its loans at the centre of today's announcement have deteriorated.
The problems at Arium are very well known in terms of the iron ore price and in terms of their debt problem. And Peabody, again, they're filing for Chapter 11 in the US. They've had problems with the coal business over here.
Investors reacted aggressively, wiping nearly 5.5% off the value of ANZ on a day when all the majors were punished. Westpac shed nearly 4% after it revealed it could have problems with loans to 5 large corporate clients, while on the consumer side of the bank, the mining bust is starting to make its presence felt.
Well, there are pockets of stress, and we're primarily seeing this in Western Australia and Queensland.
The big driver of bank profits in the last 5 to 10 years has really been this bad debt story in terms of the bad debts getting smaller and smaller. If we're starting to see a blowout in bad debts with a growth profile which isn't particularly strong in terms of housing lending, that does take a lot of the impetus out of bank share prices.
Today's announcements from ANZ and Westpac are another sign that those easy profit gains from cutting the provisions for bad and doubtful debts are over. But the big shadow hanging over banking is housing, which is by far the largest item in their loan books. To the point where Australian banks have the highest exposure to housing in the world.
Australian banks are a little bit of a one-shot bet, really, and it would be catastrophic at the moment if we got either a rise in interest rates or a rise in unemployment, and doubly catastrophic if you got both.
Just a day after Woodside shelved its Browse liquid natural gas project, the message from banks today is that the fallout from the end of the resources boom has a long way to go.